for the debt ceiling deal. On a fundamental level, it seems that the inverse correlation between the dollar and gold is evident, as the weakening greenback has allowed gold to gain. In this report, we aim to shed light on the catalyst driving the precious metals price and asset future outlook. Last Friday, the release of the US employment data for May sent gold's price to lower ground, as the mixed employment report surprisingly provided support for the greenback. The employment report noted that the unemployment rate increased faster than anticipated from 3.4% to 3.7%, whereas the non-farm payrolls figure came in at 339K compared to the expected figure of 180K. Thus vastly exceeding analyst expectation of a loosening US labor market, and in the aftermath of the employment report, it appears that the NFP figure outweighed that increase in the unemployment rate and as such provided support for the greenback. However, the greenback's rise was only temporary, as yesterday the ISM non-manufacturing PMI figures for May came in lower than expected, which was indicative of the services industry expanding but at a slower rate. The ISM non-manufacturing PMI figures reignited fears that the US economy is not as resilient as was previously anticipated, and as such spiked fears of a potential US recession in the near future. Therefore, gold may have received safe haven inflows given its status as a hedge against times of economic uncertainty. We are currently in the FOMC's blackout period, with the monetary policy meeting set to take place on the 14th of June. We highlight the difficult decision faced by Fed policymakers. One of the last Fed policymakers that spoke before the blackout period was Philadelphia Fed President Harker, whose comments about potentially skipping the FOMC's next meeting was perceived as dovish, with the indication that the Fed may pose its aggressive interest rate policy. The comments made by Philadelphia Fed President Harker may have been a key factor behind the dollar's weakening, as it could hint that the Fed is nearing its terminal rate at a faster pace than previously anticipated. In addition, despite the employment data, it is our own personal view that the unemployment rate may be the predominant factor in the Fed's interest rate decision, which is due next week on the 14th of June. Market analysts expect the Fed to pause in its next meeting, with their own personal view being that should the Fed pause, the forward guidance will lean slightly to the hawkish side, suggesting future rate hikes in the future. Whereas should the Fed hike, our view is that the forward guidance may lean towards the dovish side by hinting an earlier than expected rate cut, or at the very least a pause. In conclusion, as the Fed interest rate decision nears, we may the previous capitalize on a weaker dollar, as the market sentiment currently appears to be leaning towards an interest rate pause rather than a rate hike. The drama surrounding the US defaulting on its debt has evaporated following last week's decision by the House of Representatives and the Senate to vote in favor of raising the debt ceiling. As a result, market worries of a catastrophic scenario have now dissipated, with the greenback temporarily receiving inflows, as investors regain confidence in the US economy. The raising of the debt ceiling resulted in stronger greenback, and given the precious perception of being hedged in times of economic uncertainty, the aversion of a US default led to the gold bullion weakening. Thank you for watching.